Welcome everyone to the Kendall Report. It is Thursday night. This is the final video, so remember to subscribe and like these videos. Hit the notification bell so you know when I do my live shows and when I post my videos. Tonight I'm doing it live. I wanted to wait for the database. After getting over 6,000 buys yesterday, I had to see what this was going to look like, if it was a complete disaster, whipsaw, what have you. I've got the details for you here in a few minutes. And I can tell you a couple things about what we're seeing in the markets right now. Is an absolute insane amount of volatility. You know that. But where the illiquidity in the markets are really what's driving the volatility right now. And it doesn't mean we're not trading a lot of contracts, a lot of stock, all that kind of stuff. We're looking at yesterday that we did. I'm just looking at some volume over here, and we did a substantial amount. Usually I have it right on my screen here, and I'm not seeing it because I looked over at it. But the bottom line is, we're still getting plenty of volume. We're getting the 6 billion plus type days, but the realities is that we're not seeing bid ask, whether it's a stock, SPY, E-minis, whatever. There's no size on either side of the trade. Typically, when you get these what we call thick markets mean there is a lot of bids or offers on each side of the trade. That tells you about liquidity. So we saw just everything get exacerbated for the same reason in yesterday's move, as we traded up all the way to 43.03. If you notice, the high on Wednesday was 4,300 and change, so we still haven't got over that 43.03 number that I showed you last night. But the collapse today was just driven by obviously monster selling, but lack of liquidity. So a 200 or 300 point order, or a reasonable size, we'll just say a normal sized type of order, would drive the markets up or down. So we were just getting these swings. In the live room today, we were just looking at how the probably about 300 to 400 point ranges just to fill these orders. We're just gyrating almost randomly. And I would tell you that that's not how it used to be in the old days, 2 years ago, and maybe before. Let's go in 2019, the bid ask would be anywhere from 150 to 350 on a side at any moment that you were trading. So it would thin out and maybe get under 100, but it was always 100 plus, and a lot of times it was 300 by 200 or what have you. And there was lots of liquidity. So therefore, we used to get, if you recall back in 2019, outside of the big days, the normal days were about 12 to 14 handles. And so now, we're seeing 1,000 point down days. We're looking at these monster ranges of almost 200 points. Today, it was just short of 200 points. That's insanity to think about. And it's very dangerous. You can get caught in these things very easily, right? Or nice to get caught right, but if you get caught wrong and doing the wrong thing at the wrong time, it can be quite punishing and wipe you out. And just a story that comes to mind, back in the day of floor trading, you see these big days and they literally wipe out people. Days like we saw today, not because it was down, and days like yesterday, you can just get wiped out. You get caught in a short squeeze or this massive liquidation and can't get out of the way. It becomes a real problem very quickly, to the point where your trading career can be over. I've seen plenty of people, as I call, drug off the trading floor, basically financially dead. And maybe most of them never to be seen again. So, but the point of just talking about this is the illiquidity is the problem. And I'm going to show you here in the technicals here in just a few minutes, is there's still major support under this market. I know a lot of folks, after a day like today, this is why I try to not look at the markets. When the markets close, I step back, do my best to detach from the emotions. And you're going to see when we go through the database tonight, this is why I built the models that I did going back to 1986, 1992, when we brought it first time into software, which was TradeStation and Supercharts. But all this stuff has been around for a long time, and I've used it in my professional career. I did sell it back in 92, but didn't offer it to nobody, just used it specifically for me, my consulting, my trading that I did for many, many years. And, the whole point of this is that the whole goal back in 1980, 1984, 86 was to eliminate emotion. And, it's easy to get all tied up. I just saw just a few comments on the chat line when I was getting started, and the emotions are obvious. And, yesterday it was like, oh, was that the bottom? Is it going to keep going up? Today it's how low is low, those type of things. And it's normal to have those type of feelings after a day like this, because it's hard to detach yourself. And I'm a bit surprised at the database that I'll go through here in a minute, but it is what it is, and that's what my job is, part of it, to report to you. So let's talk about a couple things that did happen that I think are significant from an economic viewpoint yesterday. And I'm not sitting here telling you that market's going to rally. There's no bull market. Somebody made a comment, I think on Twitter or something, about my thumbnail, which said the Fed changed everything. And they did change everything yesterday. They changed everything, not necessarily for the better. I talked about last night how the taper was a joke. If they taper off, we'll be almost down to $8 trillion by the end of the year if you do the math. This is a joke. The raising of rates by 50 basis points and another 50 in 2 meetings, 150, this is a joke. This is an example of why, and I've been talking about, I do not believe that this inflation is going away anytime soon. There was further inflation embedded in all the selling today. We're so busy watching the screen and watching how it was trading. There was a fair amount of things that came out. So the productivity, business productivity, dropped for I think the first time, and at least the worst, since 1947. And this was after, and it would make sense because this was at the end of World War II, when the U.S. was a war machine at that time in manufacturing. But this is the real numbers. So they dropped 7.5%. And productivity, folks, is the key to all economic growth. You have productivity falling off, that is not a good sign. So I'm going to tell you that we are heading for a recession, maybe something really, really big. That's going to be a story that's going to unfold here as we go forward. But this is the thing. Labor costs up 11.3%. So we're seeing the cost of labor going up. We're seeing productivity going down. You're getting the equation? You doing the math yet? Because if you do, this is a formula for absolute economic disaster. And then you start stealing from everybody with inflation at 8.5. And like I've been talking about, the narrative out there is that, well, inflation's peaked and it's just going to get better and markets are going to act well and we'll end up, everything will be fine and we'll go forward. It's not going to be fine, and it's not going to be fine for a very long time. I was privy to a Twitter Spaces today that I thought was really interesting. I wish I would have found it earlier, because the people on there were quite intelligent and very knowledgeable, and they were talking about the oil patch, which I will talk about tonight, and how far we are going to be behind in basically ICE type vehicles. All of the crude oil and natural gas, anything to do with fuels, they've been demonized to the point where everything has to be electric, and that formula is not going to work. That's going to be a talk that I'll do at another time. But it was very interesting to listen to some of these things. And there were folks on both sides. I thought it was a really good debate, and a lot of interesting things came out of that. But this whole production, from productivity dropping like this is a big deal. This is bigger than interest rates above 3% at levels I can't even begin to describe this. And in any basic economic course, you'll understand that you can have productivity dropping, and especially with the economy, even though labor is tight, you can't have these things going on. And I saw a great TikTok video the other day, some girl talking about, what do you do if you have a business job? Basically, sit there and do nothing all day is what she was saying. And somebody said, hey, we were busted. Some of us don't just sit around and do nothing, but an awful lot of folks do. But we just kind of going back through this, there's something else that happened. Now, Powell told us all this stuff. There's that 0.75 raise is not on the table. So tell me why the Fed fund futures for June is pricing in an 87% probability. And the reason for it is what I'm saying right now. These productivity numbers, the inflation numbers, these numbers aren't going to downtick. And if you think about what Powell said yesterday, he didn't have a lot of confidence. You know, he thought there would be a softish landing, right? He had no confidence in that. We might have a couple more disruptions. We might have this, might have that. Basically, as they always say, they don't know what they're doing. They have no clue, and it just becomes more obvious. So, like a day like today was pretty exasperated from the point of the amount of selling and the aggressiveness of the selling. And in the live room, it looked like right at the end of the close, we might get a little recovery rally. We basically went right back to some of the Fibonacci projections that came out of the toolbox that I'm offering on the indicators. But the point is that we went right there overnight. We're still trading right where those projections were, 46.51. 1446.51. So I'll go through. Let me just cover a couple more things here, and then we'll get on to the database and get through this video for tonight. Claims came out yesterday. They were 13K worse than expected, up at 2K. And then the continuing claims, I talked about this number last night. If that was down below 1.4 million, that would be really impressive. So it was 1.384. It was definitely under that number. And I looked up something. I always talk about this, but this was the best number since 1970, right? And this is continuing claims in 1970. Well, in 1970, the population of the U.S. was roughly 205 million. So we're 30% bigger in population now. So that's what I've been talking about a number of times when I mention it, that we are actually getting down. These are not only historic numbers, not going back and looking, you know, what some number was in 1970. You have to compare the real numbers, which is the overall population, and that was just population. I wonder what the workforce was. What was participation rates? I guess I could have done a lot of research to dig that up, but all of those things are going to say that this is crazy numbers, and definitely confirms that the labor market's really tight. We already know that, right? So that's not anything new. But I think this is also the reflection of labor costs being up 11.3%. So it's just not, think about what's going on this inflation, and I'll end this little rant at this point, is really going on at these levels is that you have wage inflation, you have food going up. I believe that the fertilizer disrupting and the cost of fertilizer is going to be huge. Fertilizer is a lot of LP gas, and gas is used to produce a lot of this stuff. Ukraine's not shipping anything. Russia's not selling anything. And everything else has to be made in smaller markets, really. They're big producers. And so the cost of these things, we already know have went up. Well, we got fuel up, we got fertilizer up, and it's right now, it's prime time right now. If you're a farmer, it's planting season, and you've got to get this stuff in the ground. So it's going to be very, very pricey. And somehow listen, I'm all for electric cars and shifting the energy requirements on the planet around. But the bottom line is fossil fuels is what feeds us. And if we can't get the fertilizer, we can't get all of this stuff out at a reasonable price, you haven't seen even the tip of the iceberg on the inflation. And of course, they always take out, food and energy, so that they're cooking the books. Everybody's going to know this is going to be a huge problem going forward. All right, I think I've finished that little rant on this stuff. So let's go ahead and let's start digging into the database. And I was pretty surprised, almost as surprised, maybe more surprised than I was last night. All right, are you ready? We had 211 buys, 771 sells. We managed to stay at 41.94% bullish. So I know a lot of folks were in the live room. We were wondering what it was going to look like tonight. And what we were expecting is, it was just going to dump thousands and thousands of symbols, and all these patterns are going to fail. This is a very interesting development, and this database guides me on a lot. I don't like waiting, I don't like not having this information when I do these videos, because this is so key to the analysis that I'm doing for you folks. And it's been okay for a couple of days, but I keep getting hooked back to doing these live streams around this time of night. And when we have these big days, for whatever reason, our data vendor that we use is a little slow on getting this data. That's almost always the case on these big days, that we have a delay when we receive the data. We start looking for it almost an hour before. We just tell our servers, hey, go get this file, and it just, every minute it pings looking for the file. So we get the data within a minute of when it's available from our vendor. So we get it early, but for whatever reason, maybe error checking, I have no idea what their internal process is that they do, but we always get this late. But this is not anything like I thought I might see tonight. I was expecting maybe 2,000 or 3,000 cells where everything just dumped. And it felt that way. And this is what I started off talking about, is that the realities is that we look and at the markets trading, and that emotion flows into us. And this is the whole reason why I got to be a technician. This is the reason why we started developing rules in 1984, 86, because we knew that we were going to be human and we were going to be emotional. And we had to get this really good strategy and put the math on it and do all the work. And we did that. And this stuff, I've been looking at this database right now since 1996, roughly. And in the form it's in right now, 1998. And, I always joke, and I call Wavetech, it's got a very powerful engine, but it's sort of like a 1965 Chevy with Krager mags on it. And it's got a brand new motor. It's got a good motor, and that's what it is. It's an old clunky piece of software. It doesn't look pretty, doesn't look like all the pretty dashboards and everything, but it does the work. We've got Portfolio Expert, our pro version of software, but this is the legacy software. I believe 2002 or 3 was the last time anything was changed. I've talked to software guys to help me out with some projects, and some of them have never even seen the language this is programmed in. So, but the point is that this takes the emotion out. it takes looking at these patterns. I'm sure a bunch of these stocks from the open backed up, but they didn't break any patterns. And the models are pretty aggressive on this particular thing, especially on the 1.2 model. So, and interesting enough, 3.2 had most of the sells, not 1.2. So it's interesting because that's typically the more aggressive model. So we'll have to see how all this plays out. Just kind of go through a little further on this, is that what we have going here on the database is Friday's coming up. We're going to have our intermediate models run, and my expectations, I have none, to be honest with you. I'm going to wait and see what it's done. Right now it's only about 13, we'll call it round up 14% of the symbols in the database are long, and so maybe we'll get some new traction in spite of this crazy ugly week we've had. We still have one more day to go. So let's get into the technicals and talk about what that looks like. So I think it's appropriate. We're going to start off here because I talked about the support levels, talked about this last night, and there's a couple numbers here. On the futures, this is a monthly chart of the futures, otherwise a secular view of the markets. And the 21 period moving average right now is up at 0.81. We've actually crossed the first second derivative, so there is some potential downside on this market, but this has got enough upward momentum that we could see what I always refer to as kind of the market getting sandwiched between the 21 and 10 period moving averages. I talked, I believe, last night about that a little bit. Those numbers are 41, we'll call it 14, 41, 13.83, 41, 14, and on the upside, 44, 30. I still think this upward momentum on this 21-month moving average is likely to hold. We've traded down on a monthly basis just about to S1. S1's 40.12. Maybe we'll get some follow through. Right now we're down 15 handles, trading back at 28. Yesterday, we traded down. Let me get to the dailies here. Yesterday, we got down to 40.99.25. So we printed through 4,100. The lows were just a few days ago. We had that 40.56 number, and you can't really see them, but let me bring it up on screen here so you'll get a better feel for this. But embedded in here, there's the Fibonacci downside projection. So if you look over here, I can't move my cursor at the same time. If we look over here, 40 low target in this tab up pop up here, 40.54. We look at the low 40.56. So that target was issued back on 4/27. Okay, so we traded right exactly to that number. That's still going to be a thing. Maybe we print through it. Maybe we go down to the 40.20 level on the monthly S1 on the monthly. I don't know. And maybe we just collapse from here. But it's interesting that the numbers that came out of the database, I'm going to go back to that for a second. It's interesting that the numbers from the database didn't see more selling. That may come tomorrow. Maybe things stay down and we puke out everything that was bought off the Wednesday run and that stayed in tonight. Maybe on Friday we puke that out. I don't know. That's something we don't know. But I'll go through the daily analysis here. What's interesting is we're seeing the PPMs flip back and forth here, and look at it here. PPM 1, all of a sudden, down 14 handles, is cutting through its first and second derivative. PPM2 is about to go through its second derivative. PPM3 is flat, so we're not getting any building of downward momentum here. It's interesting because I really thought on 2 days ago that we would hold the 10-period moving average. You may recall that. We traded all the way up to the RTX number. In fact, we got an RTX sell coming into today. The high on Wednesday was 43.03, and the high yesterday was 4,300.75. I showed you these numbers last night, 43.0350 on the 28th, and there's another high right here on the 26th, 43.0350. So that is like one of those numbers that once in a while comes out of the markets and it's just staring at you when you start to look at the markets getting rejected at the same point multiple times. So that will be a key if we get above it. And if we don't get above it here pretty quick, that will also be a key. But what we're seeing is a couple of things I want to tie together here. Is first, the database did not puke out. We'll see what it looks like on Friday night. Those of you that have Wavetech, you'll know what that number is. It'll be out at about 8:30 roughly Eastern time. Actually 9:30 Eastern time will be for sure to be out. And you're going to know what those numbers look like and whether we get traction on the weekly, whether we puke out these daily trades. But the PPMs are turning up here right now on a downtick, on a 0.3, we'll call it 0.4 downtick on here. So this is encouraging from a trend standpoint that at least we're going to stay in this lower band here. Maybe 40.56 doesn't get taken out. If it does get taken out, we got 40.20 is S1 monthly, but for the most part, from an index standpoint, it's pretty tough to own this thing down here. You can take a shot and say, okay, Bob's right, that 21 period moving average it's at 41.14 on the futures. On the cash, it's 41.46. And yesterday we closed 41.46.87. So the cash S&P closed right on that number and right on the 21-week moving average on the cash. So everything's in line. We have pretty decent. Let me bring that up just real quick here so you can see it. We have decent upward momentum. We got an RTX buy signal on the cash, and so we should see the market come back in. Will it be a lot? Don't know. I would suspect that we're probably going to do at least an R1, S1, S2. But I think today is a pivot level as far as that goes. So we'll just have to use the pivot numbers going forward. But let me bring the monthly up here so you can see that number there. And I want you to see not only the number there, but I want you to see the momentum. We're at 0.75 up on PPM2. And yes, we are declining and we're losing momentum here. So there is some vulnerability, but at a 0.75, that usually suggests that we'll get some kind of bounce out of here and the markets will be able to move up a bit into the back into the pattern, maybe towards this. So let's go back to the S&P and let's get the daily ranges set up. So we look at the daily range right now. 41.0950 is S1. We've had a low of 24, high of 49. So R1 is 41.77. R2 would be a print back over 4,200 at 42.14. S2 40.71. We're getting pretty darn close to that level, that 40.56 number, which was the low on Monday. And then we have S3, STX 40.34 and 4,000. So there's definitely a lot of big range here. As I told you in last night's video, that the volatility was going to expand and we're going to move from there. Now I'm going to keep going here. I did this live for a reason. I actually ate earlier, so we're going to hang out for a little bit here. But let's go ahead and let's take a look at let's take a look up here and let's look at the quarterly chart, because this is the theme. This is the long-term theme. I threw up some Fibonacci expectations here on the screen. I'm going to try to zoom in on this thing, see if this works. So this is probably the most important chart of the moment. And the reversal that we had, you folks remember, we had a outside reversal. We closed just under the number that needed to close on the final day. It actually traded down and we got a confirmation of an outside reversal. And now all we're looking at, a couple things have happened. If you haven't seen that 3-day trade set up, go on the channel. I think there's a section there that said how to short Apple. I go through every detail of this 3-day trade. And what it is, it's an outside bar. And it's actually not a 3-day, but a 3 to 5 bar trade. And there's some rules around it. And I'll tell you the basic rules. And that's what I'm watching for. At the end, so a couple things have to happen. Once you get the reversal, the next bar, if it's a downward reversal, which this is, has to make a new low from the previous bar, which it has done now. Okay, that 41, if we look at the number, it was 40. The low last month was, just trying to get to the number, was 41.14. So now we've been down to 40.56. So we've done rule number one. There's 2 rules that have to happen. As the first rule is it has to make a new low. That's been confirmed. The next rule that has to happen is that we have to close lower. So on June 30th, we have to close below 45.30. So we could rally 300, 400 points from here and pretty much still be getting the confirmation. And what that means, if that happens, is this, is that we're going to see, if that happens, we close below 45.30 now in June 30th. We close at that level or below, we're going to get a confirmation outside bar. We're likely to get somewhere between 4 to 6 quarters of negative numbers. Now, forecast of maybe, that's why I put the Fibonacci numbers up here. It really, when you start to look at some of this stuff here, all of a sudden, you know, 0.5 is down at 32.89. That's also right now where the 21 quarter moving average is. And then we go down to 0.76, and that between 0.618, that is 29.99 and 26.31. Those are pretty extreme, but we're likely to come at least to the 21 quarter, and we're going to find all this out in the next couple months. So this is going to be a substantial pattern that I'm going to be focused on. I told you in January that I was going to be focused on the outside reversal monthly. So I'm looking for an outside reversal quarterly. We got that. Now we're looking for the confirmation of the trade. And all the rules become quite easy on the next 3 to 5 bars that are going to unfold. And it would look like that if the whole scenario that I played out tonight is that we're looking at productivity dropping, inflation still on the rise. There's still going to be a lot of pressure. We're going to have to see a lot of, I'll talk about the interest rates here in a minute. I know I've spent a lot of time on this index, but it's important to understand all of these details, I think, from where we sit right now. On the short term to intermediate, we might print down for another couple of days. But generally speaking, I think we could start to find some kind of bottom here and maybe move up, not in any big way, but back into those ranges that I talked about on the monthly, going between the 21 month, which was basically 41.14 up to a 44 handle number. And that's just a 300 point range, no big deal. We did 200 points today. Okay, so let's not make a big deal out of this. Overall, the other thing that's always out there is we just collapse and there's something out there that just takes us out. The U.S. is getting pretty crazy with supplying Ukraine with a crazy man with nuclear bombs. And, who knows what could happen, or escalation in the war and even more disruption. But these charts here are telling us that there is a giant shift. I went back and read something tonight. Just got to go on for another minute, okay? I went back and read a report that I did, and I'll put it on screen here for a second. But this was the 2017 outlook that I did. I used to do these. I actually missed doing them, but it was deglobalization. So it looked like things were going to come apart then. But the bottom line is we're actually at a deglobalization situation right now. And so anyway, the reason why I bring this up is one of the things that I discussed in this is that what we have going on here is probably a potential generational high in the markets. 48.18, nice number, all eights, a lot of eights in there. The Japanese would love it, but it doesn't look like it wants to pay any money. It looks like that could be a really big number. But I just want to start to talk about this long-term stuff. I'm just going to warn you, I'm going to end up doing this more as we go through this, but this applies across the board to all of the indices, bar none, and when it comes to equities. And, I've just got, I wish I had time. I made a comment in the live room today. I wish I'd just come on at, on the open 6:30 in the morning, my time, and stay live all day and just maybe take breaks here and there. And just because there's so much to talk about, and it'd be nice. And the best way to actually get me to do that, you folks, is to go to this link, buy the indicators, support the channel, make it more reasonable for me to spend more time. I would love that. I enjoy this. I'd like to actually put a bit of a team together. I'm looking at a couple projects that I'm trying to do that would be pretty exciting for this community and a new community. So, but this is, I'm telling you, is one of the most important things. I'm glad I'm on YouTube. I'm glad there's lots of people watching. I'm willing to put myself out there. I'm not a Harry Dent or a Peter Schiff that just keeps saying the same thing over and over. I was smart enough to realize, matter of fact, in 2017, the markets doubled from the 2017 levels. I realized that we were getting extensions and continuing to see the markets go up. And, we saw another blip in 2018 and fourth quarter 2018. Maybe that's it. And then we got 2020, and now we get this big spike. Here we are at 2022. So 5 years later, we're still getting the markets recreating themselves. But I finally think one of the elements that was in that report that I put out was that the national debt, it was at it's funny, I looked at this printout that we put in there, it was at 19 trillion, right? I thought, well, what's the number? 22 trillion, 25 trillion, here we are at 30 trillion. Who thought the Fed would have, nearly $10 trillion balance sheet, and we would be here where we are. And by the way, I do this kind of, I know I'm kind of going on multiple rants tonight here, but I think the Fed doesn't want to solve inflation, because I think the only way they're going to get out of this debt is to inflate themselves out of here. So we might just be being tricked that they actually care about it. And it was almost like one of those, I thought it was very eerie when Powell started off. Like, first I'd like to talk to the American people, like, wait a minute, this is not a presidential address. What was that? So we're doing everything, and we have a toolbox and all the crud that comes out. And I'm just like very, I don't know. I guess because it's hard to figure out what's real and what's not anymore, that it's become more difficult to buy into the BS that is presented out into the mainstream media, and everything seems like somebody made a comment, this really is the matrix that we're living in. And it's just very difficult. And maybe, just maybe, they have some other scenario and there's another iteration of this market going up. But right now I'm looking at things starting to come to a head. Elon buying Twitter, other folks out there talking about buying Disney, and just there's a big pendulum shift going on in socially right now because things have got too crazy, right? And it always goes that way. And if you're a fan of Jordan Peterson, Peterson talks about how society shifts back and forth. I think we're seeing that, and this shift is going to have to normalize these markets again, and this is why I bring up all this stuff. So I know I'm on a huge rant. How long have I been going right now? Holy crap, 43 minutes. I haven't even got to the Nasdaq yet. So I'm going to go all the way through with this, folks. I just feel like when I was after today, it kind of triggered everything into really having a deep talk about what's going on here and what all these things mean. So I know it's going to be super long video. I hope it's worth it. And once we get done, we'll mock it up as always once the rebroadcast comes up. So let's finally move on. Let's go on to the Nasdaq. All right, moving on. I think I can get through the rest of this stuff pretty quick, although there's a couple things to be discussed on the interest rates when we get there, but everything else should flow through pretty quick here. Maybe I can get done in the next 15 minutes, so that would be encouraging. All right, so looking at the daily chart, we're down 36 handles, down 0.27. We're looking at the same formation that we saw on the S&P. We're seeing the PPMs turn up. PPM, it's almost the basic same scenario. And even though we look at, we got an RTX sell on Wednesday. We got an RTX buy on today, on Thursday. Coming into the end of the week, the 10-period moving average is up here at 13,124. And we just look at from the PPM or from the market grid viewpoint, R190, 12,994, we're 889 high. Good chance we could see 13,146, which would put us right at the 10-period moving average. We got above it. There could get some further traction, but I don't expect that. We have a minus 40 on PPM1, minus 0.58. So even though they're turning up, there's still a lot of resistance at those levels. So 13, 120, 25, 140 is going to be about it. On the downside, we're looking at right now overnight 781. So basically S1 printed, not quite, but S1, S2, and I'm just telling you, if we take out S1, then look for S2, that's 569, and you're just going to have to watch these numbers intraday, like a lot of times we do in the live room. We get to these S-series numbers or R-series numbers, and we're looking for things to tell us what's going on in that point at time, whether it's we're getting a reversal or we're seeing clusters of cycles, anything that's out there. So that's what you do when you're looking at this from an intraday standpoint. On a day over day, all we're going to need to do is probably close higher tomorrow. That will satisfy the STX trade. So somewhere between R1, R2 is likely. If the world's coming to an end, then we'll just take all this stuff out and nothing matters. All right, next market is Russell. Also got an, sorry, accidentally clicked on the wrong chart. Next chart is Russell here. And what we're looking at here is an RTX buy. We also traded almost down to the fib target 2. Fib target 2 was 1836. We printed 49. We closed at 49. Closed at 71. And so that got us the RTX buy. We should come in looking at for tomorrow. This is the cash index, looking for at least an 1886, maybe even back to 1900 here. Could be pretty easy, but I would use all of these numbers, write them down, and use these as pivots as you're watching the intraday action. All right, this will be the next. I won't go too long on this, but we got an RTX sell signal on the 10-year on a daily. I keep thinking we're going to get some consolidation, maybe trade back a little bit, and we're just trading straight up. And we got new Fibonacci targets here at 3.36. We've satisfied some of the old Fibonacci number was 3.13. We got really close to that yesterday. We got 3.108, which is basically 311, 3.11. So we're satisfied that old Fibonacci projection, but now we have a new pattern that's emerged, and the PPMs are just continuing to accelerate and stay in a very strong range here from that standpoint. There's something else that's going on that is, we'll call it somewhat positive from the standpoint of the configuration of the markets. Let's go to weekly real quick here. Weekly's in this box format. So we traded right up to the weekly RTX is 3.068. So we traded just above that. We closed right at 3.066. So we closed right at RXT, just a tick below it. And we close above that, then we should get some consolidation up here. Like I said, I'm somewhat surprised that we got over 3% here, but the whole thing that's going on here is this. Let's take a quick look at the yield curve. Yield curve is now up to almost 14 ticks above. We're a long ways from inverting, and one of the things I want to talk about is that the tail, and I mentioned this in the earlier comments, is the dog is wagging the tail again. The markets are driving the Fed. And I know most people have been trading, let's say for even the last couple decades, are used to watching the Ben Bernanke's of the world and the Janet Yellen's and the transparency and all that. Well, if that's all you know, that's what you know. What I go back to Miller, and then Volcker and Greenspan, and most of the time, with the exception with Volcker attacking the stagflation, most of the time the markets lead the Fed, not the other way around. So the Fed is adjusting to the market, and that's what's happening right now. And they probably they underadjusted, and because they're thinking they're in control when they are not. So when the dog starts to wag its tail, this is what it looks like. It just continues to climb, and the Fed's going to the best thing I think we could see happen is that we would get a mid-meeting raise, even of a quarter of a point or a half, well before the next scheduled event. And that would actually shock and awe the markets a little bit. And that would probably throw us up into those Fibonacci numbers I was just showing you, 316, 330 plus. And that would be probably appropriate. I think we could end up ultimately as between 4 and 5% on the 10-year. That's very, very likely where this is going on a longer term basis. I don't think it's going to end very nicely here. And I've said for many, many years is that we are one bad treasury auction away from absolute disaster. And if at some stage people don't want the U.S. Treasuries or they don't get good coverage, that's going to really weigh on everybody, and that will be a very bad day in the U.S. bond market if that happens. All right, next market, I've got the weekly up here. So the crude oil is continuing to climb that 10-period moving average that's coming through here. It's 105.53. Right now we've seen a high of 111.37. This is pretty substantial. I think we're setting up a move, and I believe I have this set up. I hope I have it set up anyway. I'm going to go to, and I want to look at a very long-term chart here. Let me bring this up. Yeah, so I do have it. So this chart here, I'm going to attempt to zoom in again. So this chart here, and we can't see it all. Yeah, I can't get it all on here. So I'll just tell you what's up there and I'll show you. This pattern is here. I don't have the market grid on here, but the PPMs, this is a weekly pattern. And what we're seeing right now, I have the Wavetech price projection tool on here, and these are crazy numbers. We're looking at 152, 175, 189 on crude oil. And I mentioned a bit ago that I was on this Spaces on Twitter today, and one of the things that is happening because of ESG, because of the financial institutions, it's actually not as much regulations. I know that Biden and the gang has been getting a lot of heat on not kicking up the production, but they don't have to worry about it because nobody will finance it. The banks and oil's been demonized so much that they can't get financing for projects. If you give them the money, they can get the oil. And the beauty of oil is it comes out of the ground pretty quick. The other beauty of oil, gasoline, everything, natural gas, propane, we already have a very intricate distribution system that exists at the moment. And that's the only thing that's going to try to pull us out of here. But here's the problem. A, the money's not coming in. And B, because of that, we're getting more and more behind on demand, and the electric thing is never going to fill the gap. It's going to fill a gap, but not the gap, okay? And it's going to continue to be way underdone. There's not enough resources, not enough batteries, not enough of anything. And so, but it's interesting that these prices are there, and I've been continuing to, I do have the platform up. I've been continuing to suggest to you that probably one of the places to be in this current environment, even though we did see some pullback in like the XLE and some of these crude prices today, crude stocks, these are still going to be good places to hang out. Probably some of the minerals on the other side on the electric as well. So those are some of the mining. It's interesting that the play, and this may work in a recession, it may work no matter what, just because of the shifts that are going on. So, but crude oil is not going to go to $12 like Kathy Wood thinks it is. She's got this completely wrong, and it's just laughable how wrong it is. And so one of the reasons for is it's sort of like they keep taking supply away, so there's no way for prices to go down. There's one thing to talk about the shift in what's going on there, but it's not one of those things. So I'm going to stop that rant right there. But these are really big numbers that are up here. You really can't see them really great here, but they're up at the top. Get the indicators, you'll have them on your screen. But this is the crude oil from currency.com, and these values go all the way back. So you can bring this back to, this was 2008 when we were printing crazy numbers then. This was 148 on crude oil. So we haven't even gotten back to the craziness of that before the collapse. So we've got a ways to run. Some of these fib projection numbers are just getting us back to those old highs. And we're trading into this consolidation range that we traded in for years after the rebound of the economy and everything. And then we've got all these dips over here. But what we're doing is we're undersupplying ESG, financial, all this stuff is throttling what's going to go on with this stuff. So one of the things I always pride myself in, I know I was told you I was going to get done quick, but I always pride myself in finding these themes that play out. And I did that in 2020, in November 2020. This was one of them, crude oil. And then financials is one. Financials is off the table, has been for a while, but just using our sector index and the models on the index was easy to figure out that we're going to get a boost there. And then we started doing some taking and doing ETF hacking. We take our product, we tear out all the constituents, we run some analysis on them, then we rebuild the ETFs and make them better, and we can go to cash. We can do multiple layering of different types of trades. And when you do that, you're just going to end up making a lot of money on some of these, breaking these funds down and really honing in on the good stuff, not the bad. But this projection here is a huge, huge number. Is it right? I don't know. It was interesting. If we go back to the 2008 period, there were price objectives then to go to 125 to 141. It went to 140 over. It went over that number. It went all the way to 150 roughly. And so they seem kind of crazy, but the PPMs, everything that's going on here, this long-term view of oil is also something that is going to be very impactful. And I think that it's going to affect everything. Listen, I'm bullish on electric cars, but I would tell you one thing, that ultimately probably Ford and GM and all these guys that are trying to convert everything over to electric will probably get wasted because they're not going to have the batteries. So that's for another time as well. I think there's going to be a huge shift to electric, but there's not enough for everybody to compete in there for supplies and batteries. Maybe the trick will be is if you come up with something new, innovative battery technology, but yet you still have to make the electricity, and you're not going to do that with solar and wind. You're going to have nuclear. So there's so much infrastructure that would have to be built up to convert everything like that. It's probably one of the biggest fantasy hoaxes on the planet ever. I'm not saying that we're not going to convert, maybe 20, 25% over to electric, but it's not going all the way. And this stuff will, at some stage, there's going to be a lot of catch up. There's a lot of oil out there. Back in the, I think it was the 70s, I was told that we would be out of oil, but long ago, like 30 years ago. We're going to run out by year 2000 or something. They like to use those numbers. So that's not what happened, and it's going to continue. All right. I'm sorry, folks. I'm at this place tonight where I'm just rattling on about a lot of stuff, but I think there's hopefully you'll get a lot of value out of this. All right, next we'll do gold. This is Gold Weekly. It's been a terrible market. We did bounce a little bit, but we're sitting on the cliff right now. 1845 is going to be a big number to watch out for. We get below that, then we're probably going to go a lot lower. From my viewpoint, if we were to get back above 85, just on a weekly basis for on Friday, that would be wonderful. I don't really have a lot of high hopes for this metal, but I'm just going to be very brief here. 1845 is the number to watch for on the downside. On the upside, we don't get to anything until we get above 1930, 1941, and that doesn't appear to be in the play at the moment. The final market I'm going to cover is Bitcoin. We're down 3,200. And I've been talking about this. I'm going to blow this up just a little bit here and see if I can get a little better view on this action. But we're trading down toward the STX number, 35,159. 35,990 is S3, so we're trading between S3 and STX. This does not update until Sunday night. So this is a Sunday to Sunday chart, and PPMs are right now all turning negative. There's something going on here with the Bitcoin, but maybe we'll get some stability. But check this out, is that we got a huge breach of the market grid. So STX buy signal is inevitable. It's hard to tell where this is going to come in at. And this is likely to be what I would say is maybe we get some rebound. I can't tell you where the rebound's going to be because there's no numbers calculated. They won't be calculated for the next hour or so. So bear with me one second. All right, just want to get rid of that, the bot that showed up. Anyway, just to continue here is we're likely to get some rebound here, but the downward targets now are starting to become real. 33.4 possibility down to 30,000, 29,668. Okay, folks, I made it. Only an hour and 5 minutes. There was just a lot on my mind tonight. I got an opportunity to unpack that with you, and I really appreciate everybody on the channel. I just want to tell you that getting these indicators are cool. You get to hang out in the live room, and that's a lot of fun. We get to educate and trade and do a lot of cool stuff. So hopefully you'll sign up for those. It is the weekend. Thank you again. Have a great day trading tomorrow. Have a great weekend. And I will be around on Sunday night. This will be the first time in the last 3 weeks that I've had a weekend that's not disrupted with travel and other things. So it feels good already, just coming into it. Still got a lot to do tomorrow. So anyway, folks, thanks again. Appreciate you watching. Appreciate everyone. And it's awesome. This channel has been amazing. I just wish we had 100 or 200,000. So tell your friends, okay? All right. See you later. See you on Sunday night.